All right, so we're back with another deep dive, and this time we're digging into designer brands. The ticker there is DBI.
Yeah, DBI, latest earnings call, we're going to break it all down for you, give you the insights that you need.
Exactly. You don't have to read through those long, boring transcripts. We gotcha.
We do it for you.
So let's jump right in. Give us a quick overview of what happened with DBI.
Yeah, so kind of a mixed bag on this one. I'd say their fourth quarter comparable sales actually edged up a bit, which is good, but reported net sales, they were down a bit.
Okay, so why is that?
Yeah, that difference is mainly because they had that extra week in the previous year's reporting period. Remember last year had like 53 weeks or something like that?
Right.
And when you zoom out, look at the full fiscal year, both their comparable and reported net sales, they dipped a little bit.
Okay, so not exactly stellar growth.
Not huge growth, no, but here's a silver lining. They managed to hit their adjusted earnings per share target right at the top end of their revised guidance.
Oh, so they at least met expectations there.
They did, yeah. Which, in this market, that's something.
That is something these days, for sure.
Sure.
Yeah.
So, yeah, mixed bag overall, but some things to be positive about.
Okay, so maybe not a home run, but not a strikeout either, more like a double.
Yeah, I think that's a fair way to put it.
Okay, so let's dig into the details a bit. What were some of the standout highlights in this report?
So definitely some bright spots. For starters, their U.S. retail segment had positive comparable store sales for the first time in like 9 quarters.
Wow, that's got to be a huge relief for them after such a long downturn.
Absolutely, that's a big deal. And Canada retail also showed some nice growth with positive comparable sales as well. Interesting.
So both North American markets doing well.
Yeah. And then another thing that really caught my eye was their brand portfolio segment that actually became profitable for the first time.
That's a pretty big milestone, isn't it?
It is. Yeah. It shows that they're making progress on their strategy of diversifying beyond just being a retailer.
Right. Building up their own brands. Okay. So let's break down each of those segments a little bit further, starting with those U.S. sales. What exactly drove that 1% increase?
Yeah. So, a few things really helped them out there. Athletic footwear was a strong performer. No surprise there. That category's been on fire for a while now.
Seems like everyone's wearing sneakers these days.
No, right? But they also saw good demand for women's dress shoes, which was a bit of a surprise. I guess people were dressing up again.
Maybe, yeah. Or maybe they're just tired of wearing sweatpants all the time.
Could be. And then another area that did well for them was what they're calling affordable luxury.
Okay, what exactly does that mean?
Yeah, it's kind of a vague term, but basically it's like higher end brands, but not like super high end,
So like a step above your typical department store brands.
Exactly. And then accessories and kids' shoes also did well for them in the fourth quarter.
Gotcha. So a pretty broad-based improvement there.
Yeah, it seems like they're hitting on a lot of the right trends.
Okay. And you mentioned that for the full year, though, U.S. comparable sales were still down slightly over 1%. What happened there?
Yeah, so those same strong categories that I mentioned, athletic, women's, affordable, luxury, and kids, they did well for the full year too. But unfortunately, it wasn't enough to completely offset some weakness in their seasonal offerings.
Oh, so like sandals and boots and that kind of stuff.
Exactly. Those categories can be really hit or miss depending on the weather, and it sounds like they just didn't have the right stuff at the right time.
Right. Makes sense.
Yeah.
Okay, so let's move on to Canada. What drove that 5% jump in comparable sales in the fourth quarter?
Yeah, so again, athletic and kids' shoes were the big winners there, but they also got a boost from casual footwear.
Okay, interesting. So Canada was a bit different than the U.S. in that regard.
It was, yeah. But for the full year, Canada actually saw their comparable sales decline by 2%.
Oh, so they weren't immune to the challenges that the U.S. market faced?
Nope. But one thing that really helped them out was the acquisition of Rubino.
Oh, right. You mentioned that earlier. That really boosted their overall sales.
Yeah, it did. The reported sales for the full year were up over 7%, and that's mainly because of Rubino.
Okay, so that was a smart move then.
Seems like it, yeah. Okay, so let's shift gears now and talk about that brand portfolio segment, the one that finally turned a profit. What's driving that success?
Yeah, so that's probably the most exciting part of this whole story. Their brand portfolio sales were up by double digits in both the fourth quarter and the full year, like 12% and 14% respectively.
Wow, that's pretty impressive.
It is, and 2 brands in particular really stood out. Topo Athletic and Jessica Simpson. Both of those brands just blew past expectations.
Interesting. I'm not that familiar with Topo Athletic. What is that?
Yeah, so they're like a performance running shoe brand. They're kind of known for their wide toe boxes and their minimalist design.
Oh, okay. So like for serious runners.
Exactly. And then Jessica Simpson, well, that's a pretty well-known brand. It's like a lifestyle brand with everything from shoes to handbags to clothing.
Right. Okay, so it sounds like they've got a good mix of brands in there. They do. And they're really starting to see the payoff from their investments in those brands.
Okay, so let's talk about the financials now. How did their profitability and margins look?
Yeah, so their consolidated gross profit margin for the fourth quarter increased by 80 basis points.
Okay, and for those who don't speak Wall Street jargon, what does that actually mean?
Yeah, sorry. Basically, it means that their gross profit margin improved by 0.8 percentage points, which is actually pretty significant.
Okay, so their profitability improved.
It did, and that was mainly driven by their U.S. retail segment. They did a few things to boost their margins, like cutting back on promotions and reducing their direct-to-consumer shipping costs.
Interesting. So they were able to improve their margins without having to raise prices.
They were, yeah, which is always a good sign.
It is. But for the full year, their consolidated gross margin actually decreased slightly.
Why was that?
Yeah, so that was mainly because of their U.S. retail segment again, but this time it was because they had lower initial markups.
Okay, and remind me, what does that mean again? So basically it means that they were selling their products at a lower profit margin to begin with.
Gotcha. So they were being more promotional throughout the year.
Yeah, basically. And that was partly due to the fact that they're selling more athletic footwear, which typically has lower margins than other types of shoes.
Right. Okay, so it sounds like there's a bit of a trade-off there. They're selling more, but they're making less profit per sale.
Exactly. But the hope is that the increased volume will eventually make up for the lower margins.
Right. That's the classic retail strategy.
Yeah.
Okay, so what about their overall operating profit or loss?
So their adjusted operating loss actually improved in the fourth quarter compared to the previous year.
That's good.
It is, but for the full year, their adjusted operating profit was lower than the previous year.
Okay, so again, a bit of a mixed bag there.
Yeah.
What explains that difference?
Yeah, so remember how last year had that extra week?
Right.
Well, that inflated their profits last year, so it's not really an apples-to-apples comparison.
Right, that makes sense.
Huh?
But hey, at least their brand portfolio segment is now profitable.
Absolutely. That's a major win for them, and it shows that they're making real progress on their long-term strategy.
Okay, so let's look ahead now. What's in store for designer brands in 2025? What are their key strategic priorities?
Yeah, so they laid out a pretty detailed roadmap for the year ahead, and it seems like they're really focused on a few key things.
Okay, let's hear it.
First and foremost, they're all about being customer first.
Okay, what does that actually mean in practice?
Yeah, it's kind of a buzzword, but basically it means that they're using data to really understand their customers and what they want.
Okay, so like personalized recommendations and targeted marketing and that kind of stuff.
Exactly. They're also refining their brand identity for DSW, updating their customer segmentation, and improving their marketing efforts.
So basically making sure they're reaching the right people with the right message.
Exactly. And they're also planning to revamp their VIP rewards program.
Ooh, I like the sound of that.
Yeah, me too. Loyalty programs can be a really powerful way to drive repeat business.
For sure. Okay, what else is on their agenda?
Well, they're also planning to be more strategic about their promotions and discounts.
So no more just throwing sales at every problem.
Well, hopefully not. They're trying to be more thoughtful about it.
Right,
Yeah.
makes sense. Okay, and what about their omni-channel strategy?
So they're definitely investing in that. They want to create a seamless shopping experience for their customers, whether they're shopping online or in stores.
Yeah, that's table stakes these days, isn't it?
It really is. And they're actually planning to open some new DSW stores, which is interesting because they haven't done that in a while.
Wow, that's a pretty big shift, isn't it? I thought everyone was closing stores these days.
I know, right? But it shows that they still believe in the power of physical retail.
Yeah, and I guess it makes sense. They're primarily a shoe retailer, and people still like to try shoes on before they buy them.
Absolutely. And they're also rolling out some cool tech-enabled services in their stores, like digital shoe fitting tools and shoe cleaning services.
Oh, that's interesting. So they're really trying to elevate the in-store experience.
Yeah, they are. Yeah, they want to make it more than just a transactional experience.
Okay, so lots of changes happening on the retail side. What about their product assortment? Any big plans there?
Yeah, so they're continuing to revitalize their assortment, and they're really using data to guide their decisions.
Okay, so they're not just guessing anymore.
Nope. They're being very strategic about it. They're cutting back on underperforming products and making sure they have the right inventory in the right places.
Gotcha. So no more dusty old shoes sitting in the back of the warehouse.
Hopefully not. Okay, so let's talk about their brand portfolio again. What's their strategy there? So their main goal is to make their private label brands more profitable.
Okay, and how are they planning to do that?
Well, they're investing in key brands like Keds and Topo Athletic.
Right, those are the two standouts from last year.
Exactly. They see a lot of growth potential in those brands. And they're also working on rebuilding the Vince Camuto and Lucky brand businesses.
Okay, so those are more established brands that maybe have lost some of their luster.
Yeah, exactly. But they believe they can turn them around.
Okay, so they've got a lot on their plate, but it sounds like they have a clear vision for the future.
They do, and they seem pretty confident that they can execute on their plans.
Okay, so let's get to the numbers now. What kind of financial guidance did they give for 2025?
So they're expecting a low single-digit percentage increase in their consolidated sales for the full year.
Okay, so modest growth, but still growth.
Exactly. But they did say that they expect their sales in the first quarter to be below last year's level.
Oh, so a bit of a slow start to the year.
Yeah, but they're still forecasting positive comparable sales growth for the full year.
Okay, so they're expecting things to pick up after the first quarter.
They are, and they're also projecting meaningful growth in their operating income and a significant increase in their adjusted earnings per share.
Wow. So they were pretty bullish on their profitability.
They are, and they're attributing that to a few things like reduced promotional activity, better inventory availability, and the full-year impact of the Rubino acquisition.
Okay, so they've got a lot of levers to pull.
They do, but they did acknowledge that there are some headwinds out there.
Like what?
Well, they mentioned the ongoing macroeconomic uncertainty and the cautious spending patterns they've observed among consumers.
Right. That's definitely a concern for a lot of businesses right now.
It is, but they seem to have factored that into their guidance, so it's not a huge surprise.
Okay, so all things considered, what are your key takeaways from this earnings call? What should investors be paying attention to?
So I think the biggest takeaway is that Designer Brands is making real progress on their turnaround plan.
Okay, I like to hear that.
Yeah, and there are a few things that really support that view, like the return to positive comparable sales in their U.S. retail segment, the strong performance of their brand portfolio, and their focus on using data to drive their decisions.
Right, those are all positive signs. And their guidance for significant earnings growth this year is also encouraging.
It is. It shows that they believe in their strategy and they're confident that they can execute on it.
Okay, great. So before we wrap up, let's have some fun with our signature segment. Outrageous but plausible trade ideas.
All right, hit me.
Okay, so remember, folks, this is not financial advice. This is purely for entertainment purposes only.
Don't blame us if you lose money.
Exactly. So with that said, what's your outrageous but plausible trade idea based on this DBI earnings call?
Okay, so here's my thought. DBI is clearly betting big on Topo Athletic, right? They see huge potential in that brand, especially within the specialty running market.
Right, they mentioned that a few times.
So my idea is this. What if we look beyond just DBI and consider the companies that are benefiting from the growth of Topo Athletic?
Okay, I like where you're going with this.
So specifically, I'm thinking about companies that are big in outdoor experience retail, you know, the kind of stores that sell high-end hiking gear and trail running shoes.
Right, like REI or Moose Jaw.
Exactly, those kinds of companies. If Topo Athletic really takes off, it could drive more foot traffic to those stores because people will be looking for other gear to complement their new Topo shoes.
That's a really interesting angle. So you're not necessarily buying DBI stock, but you're buying the stock of the companies that DBI is selling to.
Exactly. It's a bit of a roundabout way to play the DBI story, but I think it could be a really interesting trade.
I like it. It's definitely outrageous, but it's also plausible.
That's the goal.
All right. Well, that wraps up our deep dive into Designer Brands. We covered a lot of ground today, but hopefully you now have a much better understanding of this company and its prospects for the future.
And if you're looking for a really out there trade idea, well, we gave you one of those too.
Just don't blame us if it doesn't work out.
Seriously, do your own research.
But as always, we'd love to hear from our listeners, so let us know what stood out to you from this earnings call. What are your thoughts on DBI's future?
Hit us up on social media.
Yeah, we're always up for a good discussion.
Yeah.
And until next time, happy investing.